So let's talk to who do we have here? And I've gone through several. This is my 7th company, so I've gone through all kinds of mergers and acquisition. I've acquired companies, I've sold companies, I've drowned companies, I have blown up companies. So I have a lot of stories to share with you. But let's hear who do we have on our panel, and let's get their background a little bit. So let's start with Gopi.
Great.
Gopi, who are you?
Hi, I'm Gopi Rangan. I've spent the past 10 years in corporate development. I spent many years at a company called Altera Corporation, which got acquired by Intel. So I did mergers and managed mergers and acquisitions at Altera Corporation.
Altera?
Altera.
The semiconductor
chip company. I also spent time in the financial services industry managing corporate development there, mainly doing corporate ventures, investing in startups. At Altera, I managed acquisitions between the range of $20-30 million to $150 million. The largest acquisition I did was Enpirion. It's a power systems company. Some of the smaller acquisitions are in the communications infrastructure space. Later in the financial services industry, I mainly focused on the venture capital investment side. So some of my portfolio companies got acquired. There was an acquisition by Intel that went through extremely well in the artificial intelligence space.
This is Pandharikar. I'm a co-founder and CEO of a new startup called COMMERCE.AI. Before that, I started a company called TiEcon. We were based in San Francisco. We started 7 years back, and that got acquired by the Flipkart group. And then after that, I started investing as an angel investor, invested over 12 companies before I realized that I was going too much down the dark side and decided to be an entrepreneur again and started this new company, COMMERCE.AI. So, but I'm not here to talk about the new company. I'm here to share my experience going through the acquisition for my last startup.
My name is Hulya Koch. I'm a simple example of your next door millionaire that you would never think would have been this successful in Silicon Valley. We came here with my family about 37 years ago. Started in banking, my career, and then started a company right here, importing and exporting. Found a real good void in the marketplace, exited that, and after that saw another void in the marketplace, started childcare centers, infant centers, which were inexistent in early 1980s.
You said VoIP, like voice over IP?
What's that?
You said VoIP companies?
Void. No, I said I always saw a void in the marketplace and ran after it. And after turning the childcare centers into multi-sites, saw another void in the marketplace and started an employment agency that was focused solely on childcare centers, which was again inexistent in the United States, and turned it into a national. Childcarecareers.net is the website. Turned it into a national company and exited that too. During this process, I got interested in angel investing and became a member of the world's biggest angel investors platform called Carrots to Forum. I realized that it's much better to work together with a group of people to invest. More intelligent people around you, then you don't lose that much money. That was very interesting to me, and I continued that. So I became not only an entrepreneur, but also an angel investor. In the meantime, I also founded 2 nonprofits, co-founded those, and they're also still in existence here in the Bay. Bay Area. After selling the last one here in the Silicon Valley, I co-founded the Istanbul chapter of Carrots to Forum, and now that's successfully in the process, doing very well. So I globally mentor mentees, operate these businesses on the side, and in my portfolio, I have a variety of startups. I don't focus on one, and that's my story in a nutshell.
All right. So as you know, exits comes in multiple shapes. IPO or initial public offering, the bar has really been raised. We took company Quick Turn public in '93 when we could go public on a $15 million revenue. There was no Sarbanes-Oxley, so life was simple. And most companies, like 90-some% of the company, will, if they exit, they'll exit as an acquisition. So here maybe some perspective on, is IPO possible these days, or what's the threshold like? What can you say about that, Gopi?
So I was very lucky to have one of my first portfolio companies, Adesto Technologies, go IPO. But the landscape for IPO has changed significantly. So if you look at, let's take one of the best examples, Google. The early venture capital investors who put money into Google, they rode through the wave all the way up to a point when the company went IPO. And beyond that point, the stock has multiplied many times over, and the value was not captured by the venture capital investors. So the private investors gave up a lot of value. They left it on the table.
Exited too soon.
Exited too soon.
Yeah.
So that has kind of left a scar in many of the private investors. So they keep these private companies private for much longer before it goes public. So that has resulted in, 200 or 250 unicorn companies still in private, and even companies like Uber and others are still private. So the IPO market has sort of dried out mainly for that reason, and there are other macroeconomic reasons also. So when you're looking at, if you're an entrepreneur working at a startup or putting your business plan together, you want to look at mergers and acquisitions as your primary exit opportunity. IPO is probably not going to happen anytime soon.
What does a company need to look like to be attractive? What are some of the metrics which will get you noticed? And maybe all three of you have something to say. Andy, let's start with you.
Yeah, so I think we want to also step back and see why acquisitions happen, right? And the acquisition happen in multiple stages. Like, when you're pre-seed or seed company, acquisition happen just because of the team or the technology, right? And then if you raise money, more and more round raised, then the further down, then different aspects come into play, and the metrics are different at different stages. So later stages, the metrics are, do you have paying customer, what's the churn rate, what's the revenue, and all the things, right? And then we go further down and down, repeatability and whatnot. But I had experience at the seed stage, and at that level, a lot of it is also your branding, right? What's your potential? What's your technology? What's your what's your perception amongst the competition?
Well, these kinds of things are talked about a lot, positioning and so forth and so on. But there are a few very practical things that are not discussed. The buck stops with you. You have to develop yourself as a leader. You have to form a team. How harmonious is this team? And how does your company rely on you? A lot of people have, unfortunately, a lot of ego, and the company is identified by them. But I think if you want to be successful and sustain this success, what you need to do is stand back and make your company really attractive to investors as a company that can be run by anyone. Yes, you're the creator of the idea, you're running it right now, but what if something happened to you, a truck hit you the next day, what will happen? Especially if you're going to have a private equity company approaching you. Like the previous speaker was saying, not everybody's going to do an IPO here. Not the odds are against all of us. Not everybody's going to be acquired, but some of us will be approached by private equity companies if we grow our companies successfully over a period of time. So as a leader, how can you grow this company? How can this company be systemized? How scalable can it be? I always put a lot of effort on the scalability of the company. If I were to step back, will it be run by somebody else, and will it still sustain that growth rate? Very, very important.
Gopi, you have done a few acquisitions. What attracts you?
So this is a popular phrase that everybody has heard. When you are selling a company, you don't want to be in the selling mode, you want to be bought. So if you're in the selling mode, you're not going to capture a lot of value. You'll probably sell for much less than you can potentially be sold for eventually if there was a very attractive opportunity that a target is chasing. So these metrics are great, but I don't think you can build your business with exit metrics as your goal. And that just doesn't work because you don't know when those opportunities come by. So I'll give you an example. I was an investor in this company called Saffron Technologies, which got acquired by Intel. The company was doing really well. There was a team of 15 people that was building an amazing artificial intelligence solutions. And this was before AI became the hype it is today. Now, I was one of the early investors in that space. I saw the team. The team had amazing skills, very, very smart people, and they were working on a very important problem. They were able to predict anomalies in data which could replicate the effort of an engineering team. If a few engineers left, how could you replicate the knowledge that resides in that team in future projects? And that's the genesis of the project. The metrics they were hitting was very strong just from an internal assessment perspective. But if they were to compare with, does this fit as an acquisition for a company like Oracle, it would have been a very different metric. Does it fit as an acquisition for Intel? It's a very different acquisition target. Does it fit in the financial services space, which is what I was coming from? It is a very different metric. So it's very hard to build metrics for exit. What you can do is build the best company you can build and just wait for the right kind of opportunities. When the opportunity arrives, you have to seize it. And if you're not ready, you will miss the opportunity.
Let's go to our first question. Maybe we'll go deeper into this.
Oh, yeah. So mainly, so Gopi, the question about the IPO space, and you responded by saying that people weren't so eager anymore to go public because of the Google. All this money was left on the table. They should have stayed private longer, and they could have made more money.
So your question is?
So what about the demand side? So that shows from the supply side there were some cutback in the supply, but what about on the demand side in terms of VCs? Did the crash of 2000 or other factors lower the demand for IPOs in the tech space?
The demand side of the IPO,
the Sarbanes-Oxley fiasco.
The question is there capital chasing IPO from the demand side? Yes, there is. There is a lot of capital that is not generating good returns. If you look at any of the large asset managers, they aren't able to generate good returns in the traditional way on fixed income or even large cap companies. So they're going further and further down into the riskier areas of small cap, and IPO is an area. But because of the dearth of opportunities to invest in public companies, they are now looking at some of these micro cap IPOs, and that's where Adesto falls. And there are a few other companies. There's another one, ATOM is the new Atomera. It's another semiconductor company that went IPO. There's a lot of that micro cap IPO you see in biosciences. So it is possible, but a lot of that capital is also flowing through alternate investments into the private market. So you don't see that, you don't get to hear about it because it's kind of a black box, but there is a lot of capital chasing that market, and that's why you see those unicorns.
Next question.
Okay, can you hear me? Oh, great. I just have a hypothetical question. Let's say you have an analytics platform in the e-commerce space, and you're doing a demo. In the middle of the demo, the guy says, I want to acquire you. What your pre-revenue and pre-launch? So how would you go about so you don't undersell or get too greedy? So he talked about replacement costs, obviously the cost of go to market early because it'll be 18 months before he can build one, and obviously the risk of not being able to build it. And lastly, I think the future value of the IP. So I just want broad guidelines. How would you go about getting a number on it?
How to put a valuation number on a possible acquisition?
So let's look at the value of the conversation first. Like, who tells you that I want to acquire you?
The guy who saw it.
Yeah, so let's look at the title of that person. If that title of the person had my title, he's wasting your time. I have wasted a lot of people's time. The corporate development is not the place to start the conversation on acquisition. It just doesn't work that way. The corporate development doesn't drive the genesis of acquisition. The genesis of acquisition is driven by, like Naeem said, there's someone with hair on fire, one needs to solve a problem, and they aren't able to solve the problem. That's the person you need to talk to. If someone, let's say, a C-level officer walks up to you and says, no, I want to acquire, maybe there's some credibility, but I would still not believe that story, because the person is only trying to get close to you to understand what's happening in this world, because he or she lives in this bubble away from all the realities of the world where new trends are happening. The best person to have told you this, I want to acquire you, is the business unit head who has that real problem. And he or she says that he has already failed once implementing some solution within the company and doesn't know how to solve the problem, has lost belief in his team that they are able to execute. They need inorganic growth, and that's why they need you. So from there, it's a much better conversation for you to have. How do you value and all that? It's purely negotiation, especially at your stage where you don't have revenue to show, you can't show cash flow and all that stuff. It's just how desperate the guy is. If you figure out that, you get the best price.
Hulya, do
Can
you have
I
a
just
perspective?
add something to it? Of course, in negotiations, you want to have the upper hand. So you first have to look at how groomed your company is, how ready your company is to be acquired or to be sold, or you want to do the reverse. And in order to keep that upper hand, you do a lot of networking, and you go to events pretending that you're there actually to meet with people, and your visibility increases, and people come to you to buy or to acquire you. And of course, then comes the picture of, they lack what you're providing, and they make the offer to you. And then deep down inside, actually, you do want to sell your company, but you pretend as if, oh, maybe not now. And that's a very good strategy to follow, actually.
I'll take a entrepreneur stand here. I would say take what you can get. I'll tell you my story, actually. What happens is, once you, I don't know your financial situation, how much money you raise or whatnot, but in our case, we did a pivot while we were doing acquisition. And this is how it happened, right? So you're building company, revenues are going high, people want to talk to you, and then you start to feel the crunch in the financing that you have, right? The money's running out, and that's kind of what we faced. And what happened is that while we were in a situation where we are almost raising our funding and we were almost running out of funding, there was that gap. And we started talking to company and the potential partnership situation, like what Naeem was saying. There are companies who they see your name, you're growing, but your back is against the wall. But they see outside you're growing and whatnot. They start talking to you, right? And in our case, what happened is that there's one company who came. I won't name here, obviously, and they say, we know you're growing, but we also know that you're financially stressed. So we will do a pilot with your technology, but if you fail, we would have to get hold of your IP, and we would pay this much money. And at that time, my co-founder and I were on the phone, and we looked at each other. That looks like our acquisition offer. And it was a shitty offer, but offer. So we said, can you give that in writing, that you're acquiring us? Whatever the condition it is. So we took that offer, and we never actually accepted it, but we had a first acquisition offer. And this was something that we learned, and now I look back, that was the turning point, is moment we talked to new investors, new customers, we said we had an acquisition offer on table, the conversation changed. So my advice to you, don't worry about too much on the matrix, valuation, whatever, just get the paper out, right? And then think about it later.
So let me talk about some ugly side of acquisition, because I have done that. When we were a bigger company, quick turn, we took it public. We had acquired companies only to bury it. We had no intention of actually using or selling the product, but we didn't want our competition to buy them. Have you seen that? How often is that, Gopi? Did you ever do that?
I've seen Cadence do that very consistently. I don't know if it's on purpose or it's just that they just didn't know how to.
What can entrepreneurs do? Should they, because they want to see their baby stay alive?
It's very hard to do that.
Yeah.
Often, coming from a corporate development point of view, it is very hard to justify shareholder value creation by saying, I'm going to acquire this company to kill the business. That just doesn't work. I mean, that thesis for acquisition will not float. And I cannot drive an acquisition transaction based on the thesis that we will acquire competition to kill it. Just doesn't work. It's usually a nice story that's painted later as if it all worked out okay and that was the original plan. But often the real story is that they just didn't know what to do with it. That they didn't know how to integrate the solution.
So let me ask you, what are the 3 mistakes entrepreneurs make that can screw up their acquisition possibility? And all 3 of them can opine on what are some of the common 3 mistakes.
Only 3?
Yeah, let's start with 3. Because it's easy to do first one. The second and third are the harder.
I think, like what Gopi was saying, for my first mistake that I didn't do it, but I've seen startups doing over and over again, is they try to sell their company, and it's just a bad start, right? I mean, so there are inflection points at which you're better off selling the startup, right? So the inflection points are what? Like just before you're raising your first round, or just before you're raising your second round. So you've created this value and you have an option to either raise a new round or capture that value that you've created from the last round, right? And I've seen that companies who either don't think that strategically and then go out and almost running out of cash and they try and sell the startup and it's almost never works, or even if it works, it's the bad deal that they get. So I think for me, the number one thing is like time it and don't try to sell it. Like let them come to you.
Okay.
Timing, yes, is very, very important. What stage the company is in. Having run several companies and getting acquired or selling them, I found out that there are ups and downs, yes, absolutely, but cycles. Business go through cycles, and the businesses hit a snag, and at that point they have to come up with a better team, more funding, something innovative has to happen. And then if you're successful at that point, you pass that stage and then you move on. So you have to know, and most entrepreneurs, unfortunately, like you said also, Andy, don't know where to stop and continue going on, and then selling a business like this is difficult. Timing is important, and some of them are too ambitious. Haven't we seen lots of examples of a couple of $1 billion on the table? No, I want more. And then 100 million, and they'd be happy with 100 million. So ambitiousness is not good. Since I'm on both sides of the aisle, I can see some traits. And another one is luck. Luck plays a big role, and we don't know when things are going to be headed to downturn and when things are going to be upwards. The third company I founded, I sold it right before the deep recession set in, and that was in 2008. And if I had been 6 months late, I would have been really in trouble. In trouble meaning I'd have to stay on heading the company a little bit more until we were out of that deep recession, and that would have been probably 3 or 4 more years, as we all know.
Gopi, common mistakes you see?
There are, of course, many mistakes. I feel that the most prominent mistake that people make are they set very incorrect expectations for themselves. So look, if you're a CEO, raise your hand, or if you work for a CEO at a startup, raise your hand. How many of you, if you're a CEO or if you work for a company like that, will that CEO stay in that role if the title was taken away? Raise your hand if you believe that that's the case, right? Very few people. Most of these startup CEOs, founders, they are in that position because they are in charge. that's where the drama stops, and they're the decision maker. It is impossible for someone with that personality to survive in a large corporation. Very few people do that. So I acquired a company called Avalon Microsystems, didn't have a CEO. Have you ever seen a company without a CEO? This company had a CTO and a VP of sales, and that's it. The guy was very, very clear. He wanted his baby to survive. He didn't care where it was. All he wanted to do was he wanted his technology and products and services to have a future. And that was very clear to me when I met him. And he was a CTO without a CEO. So after I acquired, he stayed for 4 years, lived through his earnout, and then he left. So I would consider that as a successful acquisition. I see that happening in a few places, like Andy Rubin's a great story with Google. When Andy Rubin came into Google, he stayed for a long time. Today we see Nirvana, when it got acquired by Intel, the CEO of Nirvana is given substantial responsibilities to build the future of AI at Intel. I mean, if the CEO has kind of morphed and developed his vision for himself, that's what he wants to do, and then the baby survives. So there is something beyond than the project that you're working on or the startup that you're working on. There's a greater vision that you live for. If you have a CEO like that, you will survive. Otherwise, your baby will die.
So let me give you my list of common mistakes which screws up acquisition. Number one is your IP is not clean. In other words, people have done development for you, but there's no consulting agreement assigning the intellectual property to the company. So then when they do all the handshakes, everybody likes what it is, we start looking into it, your IP is not clean. You can kill the acquisition. For example, when my last company was acquired by Oracle, they spent 2.5 months running Black Duck software to go through every single line of our source code to see was there any open source and did we have the proper license. You have GPL, you're dead. LGPL, kind of dead. MIT, okay. BDS, fine. So you have to figure out, do you have the license? Otherwise they made us rewrite the code. So that took forever. So that's not having or not proper assignment. Having screwed up on your cap table. When people can demand that we own this much of the company, but they're not on the cap table. That things can fall apart. And of course, not having your key employees locked in, because they're not just buying a source code. Source code is useless without the people who wrote it who understand it. So if you haven't locked in your key people, and usually acquiring company will identify what's your key people, and they want to make sure they all come over and don't disappear, otherwise your value goes down. So these are common mistakes you have to really think about when you're preparing yourself ready for acquisition.
So one comment I want to add, it goes back to my last comment, is that you don't, one thing I learned is you don't go linearly, like you raise money, then you look for exit. And I've seen entrepreneurs making that mistake. You got to prepare that pipeline right before you actually start thinking about exit, right? You need to know who are the potential acquirers. You need to know their pain points and why.
The strategy, where the weakness in the strategy is.
Yeah, exactly, yeah. And so, it doesn't matter what stage you are, but you always think that, potential acquisition as your, the thing that's going on in your mind all the time.
So there is a sustainable, profitable company, right, which doesn't need more investment, and starting to get offers from private equity, multiples of EBITDA and all that. And the company feels, hey, I'm growing, maybe I wait a year, I can make even more. And so that's the situation. Or do you sell into something where you retain certain equity and then you still grow the earnout because you're so confident, and also it becomes a little bit of my baby kind of a scenario? But wanted to, based on your experience, right? Of course, things can go down and stuff like that, but how would you treat that situation? Or
the advice I usually give to entrepreneurs is that usually this question comes from early entrepreneurs. It's usually the first company or the second company. By the time they do their third company, they know exactly what to do with it. If it's your first or second company, especially the first company, the best thing to do is sell. The best thing to do is sell because you have an exit. You have a story. It's on your resume. Even if it's a $5 million acquisition, fine. Because the next opportunity could be a $50 million acquisition. Mm-hmm. Then the third company could be a $500 million acquisition. You can keep going. If you hold on to it, then you're taking a risk, which might be okay to take the risk if you see all the leading indicators lined up. Otherwise, the best thing to do is sell it, have that story, so you'll be a lot more credible as an entrepreneur.
When you've put your first 2 or 3 million in the bank, your whole perspective changes. You're able to take different risks. You're not as freaked out as you used to be. So you're right. The first time you take some money off the table, then you could be more aggressive next time.
Yeah, your acquisition are not driven by survival. They're driven by thrival, right?
Hi, this is Prasad. The question is, so whether it is an IPO or acquisition or whatever your exit is, what are the key things you need to have? Whether you need to have an IP or whether you have to have a sales, whether you have to have a revenue, what is this? Because this field is that I can't really hold on to an IP.
We understand the question. Good question. Yeah. What do you need to have to be attractive, to be acquirable? And you kind of answered your own question, but let's hear it.
Yeah, I mean, I initially said the same thing. In order to be attractive, I'm looking at it from both perspectives. I'm an entrepreneur and also an investor. What is it that's going to be attractive? First of all, I really do want you to think about the traction part of it, validation of the idea. How much are you selling? So how is the revenue growth? So how are you building that? And then how are you building the team? How are you moving this business into the right direction? How is the team working together? These are attractive things, things I'm going to look at as an investor. And I still do want you to, as an investor, I still want you to think of an exit strategy of some kind, especially if you're trying to get investor money, because I don't want you to turn it into a hobby business. You know, you can do wonderful things, but do it with your own money, basically.
And didn't you sell a company to Flipkart?
Yeah, the Myntra and the Flipkart, yeah.
Yeah, what attracted them? What were the key assets why they bought you?
I'm still trying to figure that out. No, definitely. I think, like I said, like the initial stages, you get acquired for the team and technology and product, right?
Yeah.
So if you have one of those or 3 of those, and for us, we think that we had all 3 of those, you are already attractive. And also, you don't want to be projecting yourself as attractive company. If their customers, their competition is talking about it, you're already attractive, right? So it's always supply and demand. Do you have other people ready to buy? That makes you attractive.
So as a services company, it's very difficult to get acquired for multiples. Like if I was an acquirer, I wouldn't pay more than 1x EBITDA. Why would I? Now your name is Prasad. Maybe I want to give you some Prasad. I'll give you 1.2x. That's about it.
Now 1x EBITDA, 1x sales.
EBITDA.
Really?
Of course. Like,
You're tough.
Oh, surprising.
Yeah, that sounds low, man.
Yeah.
This is starting bid. He's negotiating.
Yeah, all my businesses were service. Yeah, the
1x
common
sales,
thread
2x
for
sales?
I had lots of excess. No, especially
Give us
with
real numbers.
last one, it was millions of excess. No.
So, Gopi.
So it is the void that you find in the marketplace, and how when you're under the radar, build your customer base, and then you become so big that you crush all the competitors who want to come along. I never even thought about acquiring any of my competitors because they didn't really have anything different than my company. So I think it's separating a technology company, separating a service, and I wouldn't generalize. I mean, if the company is doing well, if the company has a great growth projection and has proven it and is going up the hill, then it's attractive.
Yeah, for a services company, suppose you have, let's say, 500,000 customers, a acquirer can see what else could we sell to the same 500,000 people if he bought it. They're buying your customer list in the relationship.
Yeah, I'm from drug delivery automation industry. My name is Karun. I don't know if any of you have any background in biotech or pharma companies. The question is, we are at the starting stage, and then still the product, we are working on the product. However, by the time we go through different stages of testing and by the time we have the product ready to be accepted and marketed, the risks are so high that all others will also be there, the competitors. However, if we sell ourselves too early, our valuation will be so low, and we will be selling just simple idea, not really the product. Do you have any comments on what is an optimal time frame or the time window that we should think about acquisition? I mean, being acquired.
I have experience in this field as an investor. In my portfolio, I have several pharmaceutical products, and just this last Friday, I had one of my exits in that field. I know what you're going through. As an investor, of course, as an outsider, actually, not running the company, I could feel the pinch and also the pain as they went through certain stages. Well, you can still find some innovative ways of capitalizing what stage you're in. For example, the company that just had the exit last week did this, which was very innovative. They had raised a lot of money, 13 million, not too bad, from angels alone. And their product was in second stage, still some time to go, needed 50 million more that we weren't willing to put in. I had invested in two separate stages. So what they did was they acquired with whatever they had an existing company that was traded.
Reverse merger.
What's that?
Reverse merger?
Yes, exactly. So now they're publicly traded. Now I can, after 6 months of that grace period, I can get my exits back. You know, the investment I put in, and it's going to be a minimum of 2.5x. So you can see what possibilities are out there, how innovatively you can turn those to your advantage. There's no sort of first stage is better than the second stage. Also, the likelihood of attracting more investment is a factor. You know, in this situation, yes, they had 13 million already invested cash in the bank, but they needed 50 million. But with this acquisition of the other publicly traded company, which had a lot of cash, it was to their advantage. Now, of course, they're on a quicker path to completing the third stage. So that's my first-hand experience and advice to you.
I mean, to generalize that, companies build product, then they have to sell product. So right now, to get to the next stage selling product, you need a lot more capital. So good time to exit would be right when you just finish building the product and you have some early customers, because go to the next stage, you're going to raise a lot of money and take dilution. See, the thing to realize is, as a entrepreneur, I can get an early exit, let's say at 20 million. I own maybe 50% of the company. That's pretty good for me. If I take investors' money, now company has to exit at 100 million for me to make the same money because I'm diluted. Now I'm in jail for next 4 years, trying to work really for the VCs. So there's some thought process here when to exit, and maybe you want to comment on this thing.
Yeah, so that's a great thought. Actually, timing is a number one thing, that when do you sell company? And we had so many sleepless nights once we had our acquisition offer, and there is no perfect answer, right? The ballpark is, do you have this inflection point before you start? If you raise money, do you have to wait till the next round or whatnot? The other thing that I saw trigger is if your competition, like if you see your competition getting acquired, I don't know specifically in your area, but technology, if you see suddenly some competition getting acquired, there is some value to be put, and there are other buyers as well. So maybe you're not in the inflection point, but since the market is ready for acquisition, maybe you should start thinking about acquisition as well.
Hi, I'm Shri. I spent about a year and a half developing an online video product, but I'm at a stage where I'm forced to, because we haven't started selling, haven't figured out revenue, forced to go back and get a job and do this on the side as a hobby. So what would you suggest should be the focus, to sell, to raise venture capital, to build it into something that generates revenue on the side? I'm sure you've seen many companies probably in these situations. There may not be one best answer, but some of the thoughts would be helpful.
I feel a sense of tiredness in your voice. I think you're done. I don't see the excitement like, I have this video platform. It has so much potential. I cannot believe this is going to be better than YouTube. If you said that, yeah, okay, come to me, talk to me, maybe I'll invest. But you're like, I am done. I want to get a job.
No, I mean, it's the sense of...
Just run it to ground, cash cow, keep it in the bank.
Okay.
Use it as a buffer to find the best job and don't rush into anything soon. That's all.
And sometimes it's okay to go back and get a job so you can keep the baby alive because you're looking for the right moment or keep developing it. But you got to have the passion. And you have a good point here. Because if you lose the passion, why waste your life? Do something else.
Yeah, there has to be a burning sensation for you to continue. You have to be relentless. I mean, you just have to say, I'm going to have this baby. Just start walking, just start running. I can't kill it. And if you don't have that feeling, then don't do it.
See, the journey is so hard that you have to be irrationally committed to this idea, almost illogically, like you're going for Hajj. You're willing to walk through the desert because you see a bigger purpose there. If you don't have that thing, get a job. Nothing wrong with that. Next question.
Hi, my name is Love Beechel. I have a company, NeoStancil, which is a live streaming platform focusing on education. I'm really excited about mine. It is one of its kind of company in India.
Hulya, did you bring your checkbook?
Yes, I did.
So my question to you was a little bit on the acquisition timing, which got partly answered. And along with the timing, I wanted to know, is there also a size that you should keep in mind, especially for a first-time entrepreneur?
The size?
What I mean by that is, like, as you keep on growing, so we are growing month-on-month 40%. In 1 year, we have crossed $1 million in revenue. When we're looking at the possible acquisition value, then the higher the value gets, the less number of options you have in terms of acquirers. So I am hearing this theme repeatedly across many sessions that first-time entrepreneurs should focus on that exit and validation of success. So I wanted to know, like, is there also a size that we should keep in mind that, okay, this is more probable to exit at $20 million?
Are you being approached by acquirers? I guess not.
We did get an offer, yes, which we rejected, and that was under $10 million, so we rejected the offer. And now we were thinking of more, but since I'm hearing this theme that it's better to sell for first-time entrepreneurs.
All right, panelists, do you want to correct your earlier statements?
Well, if you want to give me the floor, I don't have a straightforward answer for something like this because I think you can't generalize. I would first do, as an investor, a competitive analysis. Who are your players? What kind of funding have they gotten? What revenue level they're in? Has any one of those been acquired by any of the VCs? So there's no straightforward answer for you right now before further research.
Let me give you a couple of my last thoughts also, because a time will come when if you're lucky enough to have an M&A discussion, remember this. It's like longer a patient stage on the surgical table, more bad things can happen. You got to sew it up and get it out of there. And a lot of first-time entrepreneurs want to negotiate this and that and just drag things out. It's like you're too long on the operating table. No good will come out of it. So we want to be quick, want to be able to be ready, want to be able to be upfront. So it's process, and many times, don't have your lawyer do the negotiation for you. Lawyers are supposed to do legal stuff. You need a business strategist. So I always have sought out to some outside coach, or I've been a coach to other people. Like, how do we deal with this situation? I'm going through one of the company I'm on the board of, acquisition right now. It's been dragging on for 2.5 months, but we're strategizing how to respond to different things. So get a coach, don't do it alone. People have gone through this, they know the recipe, what can go wrong, what can go right. Ultimately, your job is, don't get so attached to it. You want to sell something, make some money, do it again, because now you're smarter, you have credibility, more people want to join you. When I started this company, TeleSense, 8 people from the previous company wanted to come work for me just for stock because they knew if I got in an exit, I probably will get an exit again. So that's how you build your reputation index. So I hope this session was somewhat valuable to you. Go have lunch. Bye-bye.